Good morning. This is Ken Long from Tortoise Capital with a review of the weekend reports for May 11th, 2014. Happy Mother's Day. Bullish normal market using weekly RSI 14. The market is neutral on an annual basis. On a short-term 10-day basis, it's at 72 out of 100 on the 10-day NDX, so both are at the higher end of neutral. Looking at market mosaic, price relative to the 200-day moving average is red bullish at 6.14. The slope of the 50-day moving average has degraded slightly to yellow neutral at 0.002. ADX is anemic 9.9. Should that cross back above 15, then that would be the signal of the beginning of the next dominant intermediate trend. ATR percentage remains low at 0.83%. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold is 1.0 for the boundary between risk on and risk off. It's right at 1.0, so we're on the edge of risk on right now. We take that score and compare it to the last 5,000 days, find the Z-score. Our risk Z is at 0.51. You can see a 90-day time series here on this histogram. After a slight pullback, it's pointing the way towards declining volatility again, so the risk on trade is favored. These are the current holdings in the blended monthly rebalancing, with the next rebalancing due on or about 1 June. These are the current leaders in each of the populations of the different portfolios as of Friday. In ETF2, the theoretical exposure remains at 70%, with the model portfolio at 80%. For your reference, a quick look at the blended monthly rebalancing portfolios. The ETF 13 has three symbols on cash, which is priced below their 88-day or 4-month moving average. That's the technology, U.S. small caps, and Japan. Those are the three weakest symbols. ETF 32 has a handful also on cash, tending to be the U.S. indexes plus China and Japan. With Brazil, energy, and agriculture at the top, continuing that trend. ETF Max looks at the top 50 of the 1,300 ETFs in the database. Nickel, agriculture, coffee, India, Indonesia, Egypt, Brazil, and so forth. The ones that are green on this in the 3-month column and either white, yellow, or red in the 6-month column are ones that have become recent additions to this report. They've accelerated their gains mostly in the last 3 months, not the last 6 months. So Turkey remains interesting, as is Brazil financials, Colombia, biofuels, more Colombia, Indonesia, and so forth. So we're looking for emerging strength earlier in its life cycle. That's when it gets interesting. Looking at the S&P 500, these are the top 30 or so in the S&P 500. I guess the top 40 in the S&P 500, and the sectors that they are coming from. So you can see right now strength in Forest Labs and Allergen and XLV, the healthcare. And again, we like green and white or green and yellow as early market leaders. Next up, the market health check. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets to the upside. The red lines are support levels that have held in the past that used to be resistance and which act as price targets on the downside. The dark blue shaded area is the river. That's the 30-period Bollinger Band plus or minus 1. The floodplain is the lighter blue shaded area, Bollinger Band 30 plus or minus 2. The pinkish shaded area in the middle is the dragon, the river dragon. That's a 10-period Bollinger Band plus or minus a half, which is a front runner of turns in the river. And when it makes extreme moves like it did here in early February, that gives us alerts to interesting intermediate term extreme conditions. You can see that for the past really 60 days, this has been one sideways chop after another, stabilizing lately in the upper half of the river above the Bollinger Band mean. We've got three sets of RAF regression channels on here. The blue, um, this is the 10-period regression line, slightly tilted up, and the regression channel is formed by the maximum excursion during the look-back period. The black is the 30-period, lagged by a day. You notice that's also pointing up, not quite as steep as the long-term, which is the 90-period in the dark green. All three regression channels are pointing up. The fact that the 90 is a little steeper than them suggests that this slightly weakening in the shorter term, so it has some room to go to catch up to the longer term or the 90-day period. Notice that's just about parallel with this 200-day moving average and the region below. Price is above the Bollinger Band mean, and the dragon is above the Bollinger Band mean, right on the edge of the northern slope of the river. We're looking for a price breakout to the upside here. When the price gets into the green, if it breaks out above the river, that's where I want to, by default, be long on my intraday trading and on my swing trades. When price is in the yellow zone, where it is right now on the boundary, I wait for market direction intraday to get me either short or long, because then there's increasing probabilities for these big one-day directional candles, even against the trend like you've seen here in the last 30 days. So this is a market that's been stabilized, or I think just meandering here for 50, 60 days. This has been difficult for swing trading. There hasn't been much follow through. Although in some indices like Brazil and Latin America, we've actually seen considerably good moves. So you got to cast your eyes a little wider. But this is setting the tone for the market right now. Failure to fail further has been sort of the dominant theme, but there hasn't really been the kind of follow through that the bulls would like to see, such as this when it climbed out of the hole here. So this is looking like sideways quiet channel. And the lack of trend here in ADX, you notice, is at 9.8 is extraordinarily low. And so this is a market that's poised to move in either direction with an intermediate term swing. And you can see right now the bulls and the bears are about equal in their grinding. Right in the middle of the channel for Williams percent R. Percent price oscillator also has gone to zero, so we have no trend right now other than this sideways chop, and that's a time for patience. Don't try to do too much. Be ready to follow breakouts with a measured approach to position sizing, but the next move should be large because of this significant base that has been established. The ETF2 regional report remains at 70-30, with the strength slightly tipped in the favor of the U.S. over the globals. Inside the U.S., it's large caps, mid caps, tech, then small caps. The two strongest sectors remain Asia less Japan and Latin America. Two weakest are U.S. small caps and Japan. World market model, slight improvement in the U.S. over last week. Japan remains in the red. Asia less Japan is strong, as is Latin America. India, Philippines, Indonesia are really leading the way in Asia. Belgium is the only in the green. And notice just the absolute follow through in Brazil. I think there's more room there. Just a relook at the top ETFs from the ETF2 database. Again, we like to see things that are green and then white, or green and yellow. Turkey, therefore, is interesting. Colombia, South Africa, Brazil, more India. Again, this is an early way to catch significant macro trends that are happening on a weekly basis. Inside the Dow, it's Caterpillar, ExxonMobil, Disney, AT&T at the top, with interest in ExxonMobil AT&T and Johnson & Johnson should be rewarding, and Travelers, which is green and yellow. That's kind of unusual in the Dow. You see weakness creeping into DuPont and Microsoft, which are white and then green, and weakness in Merck, which is white and green also. Bottom feeders, new candidates at the bottom. JP Morgan and Pfizer are red than yellow, so they're failing faster on a relative basis. Boeing could be early in its turnaround phase here, being yellow and red. And liquidity stats, just for your reference, these are based on the top 30 daily dollar volume of trade, and their ATR percentage. Those in green are exceptionally volatile, and those in yellow and red are less volatile, of course. Shifting to the daily, no signals in overreaction or channeling. You see the steady decline in trendiness, a handful of channeling and overreaction trades, some triple screens, a 551W in US tech, and then the auto framer finding symbols that test out better than 2 to 1 based on trade location. No signals in RSI2, a handful of dojis. These are the auto framer reward to risk ratios. Quite a few frog candidates. That's not surprising given the quiet market volatility. ETF2, there's a couple that fire on RSI2, the VIX and agriculture. A handful of dojis once more. And you can see the channeling overreaction, a triple screen in utilities, and a 551W in the NASDAQ, and then 4 auto framers. This is the auto framer mechanical trade framework. I'll leave you to look at the stats. Pfizer, Home Depot, Merck, VIX, Gold, JP Morgan, Microsoft. Some good names in there. See how just how choppy this market has been. And the 30-day regression line is the blue line, and the polynomial regression line still favoring the upside. You can see the time series of that slope over the last 30 days and how that fits inside the last 6 months, with it just above the 6-month average. Just below the 6-month average and just into the positive area here. Still some room for this to go, but you can just see how choppy this has been in the last 30 days. Longer term historical context. So that's everything I want to cover for the weekend report. Take care of your moms today. Happy Mother's Day. Keep your powder dry and wrist measured, and we'll see you in the chat room.